David Tepper, who founded the hedge fund Appaloosa Management, said the stock market is the second most overvalued that he's ever seen. However, Nelson Peltz of Trian Partners said there is loads of value in the stock market and that he's putting his capital to work. So, who's correct? Well, let's take a look. Once again, the question: is the market overvalued or is there loads of value? This kind of question is more important right now when investors have no idea what to expect for corporate earnings and revenues in coming quarters. As a result, traditional quantitative measures like value, growth, and quality will become meaningless when coronavirus impacts corporate financial statements. One valuation indicator with a good long term record can help because it doesn't rely on either earnings or revenue projections. It's called the Q ratio and it's calculated by dividing market value by the replacement cost of assets. Taking a look at this chart here, which is based on data from Andrew Smithers, a UK-based economic consultant, the chart shows the Q ratio for the S&P 500 index back to 1900. Higher levels mean the market is more overvalued. So, with the Q ratio currently in the upper levels, this would argue that the market is toward the overvalued end of the spectrum. As you can see, the current level is exceeded only by the stock market top prior to the 1929 crash and at the top of the internet bubble in early 2000 before the dot-com crash. However, given the level of Fed interaction with the markets, this indication is also likely marginalized. So now let's take a look at our chart so that I can show you something that, to my knowledge, no one else has even considered in this current market. And we're now looking at a 15-year chart on a weekly basis. And this is the spiders, the SPY, S&P 500. We're only going to look at this chart here because the NASDAQ, the Dow, and the Russell 2000 all have similar characteristics. And this is going to be real quick. This is the price chart we're looking at right here, but we want to take a look at volume. So what I want you to notice is that the current level of volume at this point here pretty much compares maybe with back here in 2011, but much less so. Maybe a better comparison is 2010. But if you go back to the great financial crisis here in 2008, 2009, look at that volume climbing on up and then declining. The climb up here in 2010 and then the decline. Here in 2011, climb up and then back down. Now here in 2015 to 2016, we had two little peaks up and down here. Certainly, this level and amount of volume that we have now exceeds 2015, 2016. But if you go back, it doesn't exceed any of these, the 2008, 2009, 2010, or 2011. So if you were hiding under a rock and came out and saw this volume here, would you expect to see this down here from up here? 2015, 2016, the top was there, and these were the two bottom valleys. 2011 was up there to down here. 2010 was from there to here. And then, of course, 2007 through 2009 was from up there to down here. But once more, back to that volume chart. Looking at that volume chart, I would not have expected what happened in the price chart. So I think the stock market is still a lot stronger than many believe. And I think this recovery is going just fine. I do have some concerns, but that's only temporary. In my humble opinion, I think things are going to get rumbling along here soon enough. When is that going to be? I'm not quite sure. But right now, the only thing holding us back is fear and psychology, because this level of volume doesn't indicate what we've been through. And for today, that's ChewDog Charts. Thank you.